In this video, we're going to see how to calculate the cash flows in the case of an investment. This is the exercise More Coffee, and you have all the exercise in the aula virtual if you need to check what does it say exactly. So we're going to start with a chart, as we have seen in the theory part, in the video of the theory, regarding this initial investment, and there's going to be an initial outlay. That's going to be our first step here. So we're going to calculate the initial outlay. So that initial outlay, it's going to depend on the amount of money that the company has to provide in order to start the investment. So in this case, the initial outlay, it's going to be the 45,000 that says that it's needed in order to create the company, minus the grant, minus the long-term loan that appear on the balance sheet. So that makes an initial outlay of 32,500, and this is what we are going to place in the chart as the cash flow for the first year, for year number 0. Now we're going to start working on the rest of the chart, but before that we're going to check the residual value. Whenever it explains about the depreciation, how are the assets going to depreciate, it says that there's a residual value of 500. So we're going to place that residual value in the last year of the investment, okay? Once we have done this, we can move on and we can start working on the incomes, expenses, and so on. So for the incomes, we need to know how many units has the company sold. And it says the market demand is 300,000, but the company has a 50% of the market. So the company is going to sell half of the market, 50% of 300,000, which is 150,000. And it also says that selling price is 0.4. We're going to work now on the loan, and it says the company has a loan of 7,500. So that's the loan itself, the total loan. And it says there's an interest rate of 6%. So in order to get the interest for the year 1, we're going to multiply the 7,500 by the 6%. It also says that the loan is going to be reimbursed in 3 years and same amount each. So that's why our chart is only for 3 years. And if we're going to reimburse it the same amount each year, it means each year we're going to reimburse 1/3, which is 2,500. So pending loan for the first year, it's going to be the 7,500 minus the 2,500. And that's going to be the outstanding loan on the second year. The interest is going to be the 6% of 5,000. Same reimbursement, because we're going to do the same reimbursement every year. And pending loan, it's going to be outstanding loan minus the reimbursement of that year. And that takes us to the last year of the loan. And we're going to have an outstanding loan of 2,500. We're going to multiply it by the 6% in order to get the interest. And the reimbursement, we set the same amount each year. And final loan, pending loan, it's going to be 0. It's completely reimbursed. And the next thing we need to work on is the depreciation, because that's the other part where we're going to need information here, okay? So first thing is going to be calculating depreciation base, and it says that the company has several buildings and several equipment, and all that, it's going to be, according to the tax office, it's going to be depreciated in 10 years. And there are lands valuated in 7,500 and the residual value of 500. So with that information, we're going to calculate the depreciation base, which is going to be the buildings plus the equipment, and we're going to subtract the lands and the residual value. So this is the amount we finally have. That's a depreciation base. And it says the tax office is going to allow depreciating in 10 years, which means legal depreciation, it's going to be that amount divided by 10. Once we have all this, we can move on and we can fill in the chart. So incomes for the first year, it says that the number of units sold, we already calculated, and it says the selling price is 0.4. So we just multiply 150,000 by 0.4, and this is how we get the income for this year. Let's move on to the expenses, and the exercise says that the expenses are 35% of incomes. Since we already have incomes, we just need to multiply 35% of the incomes to get expenses. Now we have the financial interest. We need to take the financial interest from here, from the chart, and the year number 1 of the investment, it's also year number 1 for the loan. So we just need to transfer the 450 to the investment chart in order to calculate the cash flows. And finally, we need legal depreciation. And we just need to copy the amount we got when we were calculating legal depreciation. With all that, and applying the operations you can see here in this first column, we can get the economic result. So it's going to be incomes minus expenses minus the financial interest minus legal depreciation. That's going to give us the economic result. Now we're going to apply taxes, and the exercise says that taxes are 25%. So we're just doing 25% of the economic result, and that way we're getting the net profit. And now we need to add back legal depreciation, which was on top, so it's not a problem. And we need to add the loan reimbursement. And again, the loan reimbursement from year number 1, it's here in the loan chart, and it's also the reimbursement of the first year of the loan. So we just place that amount, and now we're ready to calculate the cash flow for year number 1. So we just do net profit plus legal depreciation minus loan reimbursement, and that way we get the cash flow for year 1. Let's move on to year number 2. To year number 2, we know that incomes increase 10% each year, which means for the incomes of year number 2, we need to multiply year number 1 by a 10%, and we need to add it. So it's going to be 60,000 plus 10% of 60,000. Expenses are the same, 35% of the incomes. Since we have a new income, we have new expenses. The financial interest comes from the loan chart, and it's going to be the interest of the year number 2. Legal depreciation does not change, and with that information we can calculate the economic result. Again, taxes are 25%, so we can get net profit. And now we need to add legal depreciation minus loan reimbursement. And in this case, loan reimbursement is the reimbursement of the second year of the loan. Okay, and with all that, we can calculate the cash flow. And finally, we have year number 3, which is the last one in our case, because this investment only lasts 3 years. And we calculate incomes again, and we have an increase over the second year, which means we have 66,000 plus 10% of the 66,000, because it says we have an increase of a 10% every year. Again, expenses are 35% from the new incomes. We have a new financial interest, which is here in the table. We have calculated. Legal depreciation is exactly the same, and with all this information, we can calculate the economic result. Now we can do the taxes, which are 25% according to the exercise, and with this we can calculate net profit. And now we add legal depreciation minus loan reimbursement, which is going to be the reimbursement of the year 3 here in the loan chart. And in order to calculate the cash flow of the last year, we have to do net profit plus legal depreciation minus loan reimbursement plus the residual value we have here on top. So please don't forget adding the residual value. And once we have all this, we have finished calculating the cash flows, and in the following videos you will see how to use them in order to calculate the net present value, the internal result rate, and the payback. I hope this helps, and see you in the next video.